This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 27th. Some highlights from today's show. How do you trade the end of QT? Some more squeezes expected in risk markets, and the euro-dollar is ready to rally. Good day traders, and welcome to another daily market rundown. Let's get stuck straight into it. In terms of the overnight, there's not a great deal going on, but in actual fact there is something under the cover you want to be aware of. So let's get straight into it and discuss what you want to focus on very much early in the European session, as well as I expect it to flow over into the US session. And that's all got to do with the US 2-10s curve. What we can see is almost a flip and a reversal of what we've had over the course of the last 4 or 5 sessions, which was we've gone from very aggressive flattening where the back end of the curve has been driving higher on fears of a growth slowdown in the US to now quite an aggressive steepener. Okay, and what this is showing us is not necessarily that the fears are gone. It's just showing us that perhaps the market now has gone quite far in the near term. We're seeing a little bit of reprieve, and that's going to give quite a bit of confidence back into the risk markets to stage a little bit more of a squeeze. So what we're expecting today is a little bit more of the same sort of price action as yesterday, where the cash market open is likely to pop above that 60.24s, come in and test around that 60.68s. That is our first key area of resistance. Once we get up there, I suspect we're going to repeat a very similar type trade as yesterday, where we do then see the market offer its way back down and find some support a little bit higher up. Now, these exact levels, I think the key takeaway is you can see we made a higher low on Tuesday, a higher low on Wednesday. I expect the same thing today, which is a third higher low, and we can see effectively all the market's doing is funneling. Okay, the risk off has not gone away. The growth fears have not gone away. Like I said yesterday in the market rundown, those won't go away until we get some very key economic data effectively saying that things are not as bad as everyone's thinking. Okay, so that's the key play for today. It's very much expecting a little bit of a squeeze. We should get that squeeze start to accelerate once we get above those 14s to 20s area in the S&P 500. Now, our first topic for today is all about QT, quantitative tightening. There is a little bit of talk and chatter about QT ending prematurely. The general consensus, pre-FOMC meeting minutes last week was that they're going to end QT in some sort of part of half 2 of this year. Okay, that was the general line of thinking. However, given the debt ceiling discussions that's going on in Washington, there's now talk and chatter that perhaps the Fed's going to be brought into action a little bit sooner than expected. Now, as a general rule of thumb, I've been doing this job for long enough, so take this as it comes. When these sorts of reports hit the news wires and when the general media starts talking about these things, it's because they have typically been planted. In other words, the Fed is kind of starting to prepare the market for this idea of perhaps a premature quantitative tightening coming to an end, or at least a roll-off. Okay, now I'm going to show you in a minute what it looked like back in 2017, which is the only other time we've had some form of a QT coming to an end. So we'll talk a bit about what that looks like in terms of the charts. But the key thing you need to know as a trader is, what are you going to do if at the meeting coming up next month in March, if they do decide to slow down the QT, or if they do decide to pause? Okay, what is your reaction function? What do you think the markets are going to do? How are you going to trade it? Because it will be new news. It will be news that needs to be priced by the market, because right now it's not expected for them to pause or slow down QT in March. Okay, now the 3 options, of course, like I said, they can stop. In other words, they can effectively end quantitative tightening. They can also pause it, so perhaps signal a pause, but in reality, a pause means they are ending it. And the other option is to, of course, slow it down to slightly less. Now, we'll go through what they did in 2017 in a minute. But the key takeaway here is that if they were to end it or pause it, okay, effectively it's the same thing. And what that's going to mean in the current context is that we will likely see inflation expectations pick up if, and this is the key, if these growth fears subside. Okay, however, and I'll show you 2017, and that's why we're discussing this. The reality is the reason they ended QT prematurely in 2017 was because we were going through a growth scare very, very similar to what we have today. Okay, so again, a lot will depend on the context. If we are in a growth scare scenario and they do end QT, inflation expectations will initially pick up a little bit, but it all then depends on the growth scare and where we are in that growth scare and how deep it is as to what happens to inflation. Okay, but everything will ultimately lead from that point forward. So if they were to pause and stop, ultimately we should get a scenario. Again, it depends on what the growth scare is doing. If we don't have a growth scare and everything's fine, we'll see inflation expectations rise, therefore we'll see yields rise. Okay, if it's the opposite, we're going through a growth scare and they end the QT, what should happen is potentially we initially see yields rise, but then they flip and reverse and continue to move lower. Okay, so a lot depends on the context into which they are ending or pausing or perhaps slowing down the quantitative tightening. Okay, but the general thinking is ultimately what gold will do, what the steepener do, what the dollar will do will depend on why they are pausing or stopping in the first place. Okay, let's go look at 2017 and this will give you an idea of the context. Now, 2017 is the only playbook we've got. It's the only time we've seen quantitative tightening. And what happened there ultimately was they initially in December 2018, okay, Fed's Powell came out and said, look, we're thinking of slowing down quantitative tightening. Very similar to what we have now. Right now, we've been prepared by the Fed that they are going to think about slowing down quantitative tightening at some point this year. Okay? And that's very similar to what we had in December. Now note what the S&P was doing into December was we had effectively had almost a correction of 20%. Okay, so the market had entered a little bit of a bear market. There was some fear and chatter on Wall Street that perhaps the Fed had overdone it on QT, and that's why we were seeing the market sell off. There was this idea that there was not enough liquidity in the system, okay? And that's what led the Fed to come out and say, yes, we are now going to bring forward this idea of slowing QT. You can see the market, the equities rebounded very aggressively off that. Why? Because the markets like liquidity. They like the idea that the Fed will step in to prevent further uncertainty and backstop ultimately the sell-off in markets. Okay, they eventually slowed quantitative tightening eventually in March. They announced it at the January meeting, but they eventually slowed in March. So you can see ultimately the equity market had already retraced almost the entire sell-off that started in December. Okay, so this is important because it's not about when they officially announce the runoff or the pause, it's about what leads into it. And the market will front run ultimately what the Fed is telling us in advance. Okay. Note then, of course, as the year went on, equities kind of moved sideways. In July, the Fed began the process of cutting rates. Why? Well, because there was a fear of a slowdown in growth, and it wasn't above trend like they wanted it. They ultimately stepped in and started the process of cutting rates. And then if you fast forward to September, that was what is now known as QE, not QE, okay, which is they were effectively providing liquidity to prop up reserves, but doing it in very short-dated maturities. Okay, there was a big long debate on Wall Street: is this QT? Is this QE? Is it not QE? The reality is it was QE. The balance sheet started inflating. The result was equities rallied back up towards the highs. So you can see from low to high within 1 year we rallied 38% from the time that the Fed said, look, we're thinking of slowing down quantitative tightening to ending quantitative tightening to beginning the process of rate cuts. Now, I'm not saying this is what's going to happen. What I am saying is if we start to see a growth slowdown continue over the course of the next couple of weeks, that will perhaps showcase itself in the equity markets, that will bring forward the time when the Fed begins the process of ending QT and perhaps even beginning a QE or a rate cut cycle shortly after that. Okay, keep in mind we are currently cutting rates in the Fed, so they are still quite restrictive. So the context is a little bit different to what we had in, of course, 2018. Okay, don't forget the Fed was hiking into that sell-off, and hence why it's a slightly different context. Okay. If we look at the bonds, I think this is another way to look at it. What you can see is that the Fed's tightening ultimately in 2017 was leading to very aggressive flattening. Okay, in other words, this was this idea that perhaps the Fed was a bit too restrictive. They were removing liquidity at a little bit too fast a pace. We can see that because of that very aggressive flattening, as a result, at the start of 2018, the Fed stepped in to say, look, we're going to remove a little bit of this restrictiveness. We initially got that steepening. The market initially liked it, but then said, no, we want more. we're not going to accept this is not enough. You're still doing quantitative tightening. It's still too restrictive. The curve flattened even more aggressively. And what did the Fed eventually do? Well, midway through the 2018, they began the process of cutting interest rates. We can see they started cutting rates there. They did the QE, not QE around there. And we can see the curve steepened itself out. Okay, and this is very typical. Markets will always force the hand of the Fed. They'll always signal to the Fed, look, your policy is too tight, your policy is too loose, do something about it. Okay, and this is why we look at the 2-10 curve, because it is telling you whether or not the Fed is doing enough or doing too little. Okay, that's one way to ultimately look at it. So the question I had for you all in the Discord, and I think this is what you need to answer, is in the current context, at the March 20th meeting, or the March 19th meeting coming up in 2-3 weeks time from the Fed, if they did announce this idea of a QT slowdown, okay, what is your reaction function? Where are you going to be trading? Where's the opportunity scope? Okay, we know gold is at record highs, and that it's there because everyone's hedging against higher inflation. So in the current context, where things are not that bad yet in terms of growth, any kind of a slowdown in QT is going to push inflation expectations up the page. That's going to put that bid back in gold. That's going to ultimately, perhaps put a little bit of an offer in dollar, given everyone is long dollar this year. Okay, so it's very, very important. Go write out those scenarios. What are your plays? What is the opportunity scope? Should we get perhaps a slowdown in QT, but even a pause? Okay, like I said, a pause from the Fed means we're done. And that's important to understand. They will not restart ultimately QT once they pause. Okay, so just keep an eye on that and make sure you are prepared for that should that announcement come in the short term. The next news article is all about the divergence that's now happening between US and European inflation expectations. And I love this article. I think there's a fantastic playbook here that we need to be aware of. The general thinking is this. In the last 2-3 weeks, we started to see quite a sharp slowdown in inflation expectations in the US, again, because of this growth scare. On the other side of the Atlantic, what we're starting to see in Europe is perhaps inflation expectations that they're not necessarily slowing, but they now seem to have flatlined, and there's thinking that they can start to reaccelerate. Why? Well, because there's a number of things going on in Europe. One, there's talk of big spending. Okay, German government's just come in and they're talking about, opening up and spending more, a fiscal spending program, similar ultimately to what we had in the US, where they spent deficit spending for a number of years. Okay, we're seeing a number of European countries talking about this idea of spending more on military. Okay, so all of this spending, all of this money coming into the economy is going to ultimately drive up demand, and that's what's ultimately leading inflation expectations to be a little bit higher in Europe. Now, at the same time in the Atlantic, like I said, we're seeing it the other way around, which is seeing a little bit of a slowdown. We're obviously seeing a US government that's now talking about, getting rid of federal jobs, reducing the deficit, removing some of the spending. And whilst we haven't seen a reduction in spending yet, the general line of thinking is they want to spend less, whereas Europe wants to spend more. Now, as a result of that, and this is an important chart to pay very close attention to because divergences like this very seldom appear. What you can see between these two curves, okay, the purple curve is European 210s, the orange curve is US 210s. Now, what you can see is quite a significant divergence has started midway through January. Now, if you think about it, what's the best performing stock market in the world right now? Okay, of the major ones, is the DAX. It's massively diverging against the US equities. Why? Because market participants are starting to think of Europe as a new growth story, as a potential re-acceleration from very low growth expectation. Okay, now, this is not new. If you go back to the start of last year, you'll remember Madame Lagarde was getting very excited by this idea of a re-acceleration of green shoots in Europe growth expectations. The difference this time around, however, is that we are seeing a lot of consensus in Europe to spend more. Okay, and that's why we are now starting to see this divergence where the European curve is starting to steepen, the back end is starting to showcase more growth potential, higher yields, higher inflation expectations. On the other side of the Atlantic, we're starting to see the opposite, which is, well, hang on a sec, rates are very tight, and we can see that you're trying to reduce spending, and we can see the curves flattening a little bit. Now, what is the opportunity scope here? Well, ding, ding, ding. If we're going to get a re-acceleration in growth in Europe versus a slowdown in US, euro dollar is going to make its way back up to 110 pretty darn fast. Why? Well, keep in mind, number one, everyone is long of dollars, short of euros. Okay, that is the consensus play this year. You want to be long dollars. Why? Well, the Fed's got the highest interest rate. But they have the highest interest rate at a time when, of course, we are seeing growth expectations slow. Okay. Now, in terms of the euro, I expect there's a fast money move coming in short order above that 105. I don't think we stop there. I think we're going to stage a very similar rally to what we saw effectively in the middle of last year when we saw that growth slowdown. Okay. Remember, June, July, August, we saw that growth slowdown in the US. We saw euro prop its way from 106 up to 112s in a very short space of time. I expect we've got a very similar play coming in near term. Pay close attention. Now, that in mind, as a day trader, obviously my job is not to take trades for 3 months and just sit there and do nothing. My job is very much to take structural type trades, and I think the first structural trade that is in focus for today is the euro dollar, and subsequently it's, funnily enough, actually to the downside. Okay, there is an expression, I mentioned this yesterday, that sometimes you need structure to resolve before we can get the true trend. Right now, unfortunately, it does look like the euro needs to take out this 104.67s. It needs to just test in some of those weak buys. We've stagnated a little bit here. We can see a lot of overlapping VPOC. So I expect a little bit of a wash down trade. And ultimately, once we get back up above this 104.75s, I think it's clear blue skies. I don't think we're going to stop at 105.36. I suspect there's a lot of shorts that are going to start to cover above 105.40. We know the open interest is very short. Like I said, everyone wants to be long dollar. We get above that 105.40. Like I said, I don't think we're stopping anytime soon. Yes, there is some resistance at 107.50. But for me, over the, if we're going to see a re-acceleration growth of Europe at the same time, a slowdown in US, the play is very much a trend-like move back up towards resistance at 110, 111. Okay, and that's the key chart there. Like I said, that resistance comes in around that 111, 112. We'll be back inside that range that we were in for pretty much the entire last year, and we ain't going to stop in the middle of that, given, of course, the consensus was for a short euro coming into this year. Okay, so that's our key play. Let's turn our attention, of course, to Nvidia. The earnings were, well, blockbuster. It's as good as that. I mean, it doesn't get much better than that for Nvidia. It continues to shine. It continues to project really good forecasts into the future. It just is simply a blockbuster story. What does that mean for the stock? Well, look, I think we're back up above that 127, 129 area. We've held on to that 200-day moving average. I mean, this is investors' number one favorite pick. It is the number one biggest company in the world for a good reason, and they are not disappointing. I think that's the key takeaway. What does that mean in the near term? Well, look, if I was an investor, I would not be wanting to short this market. It is only a market that seems to keep on rotating. I do think that 127.29 is now key support. I think that holds. I suspect so long as that holds, we are going to make our way back up towards those record highs at some point in the coming months. Now, of course, we do have to contend with a growth slowdown. We do have to contend with quite a bit going on in the AI space. So it's not to say it's going to be a straight line up the page, but I do suspect if you are an investor, this is one of those things you do just hold on to. Okay, those earnings did not disappoint. There's nothing from those earnings that is ultimately disappointing. So keep an eye on that. I think that's going to be an interesting one to watch today. Like I said, if Nvidia, it is up 1% in the pre-market, but I suspect they could stage a bit of a rally today. If they hold on to gains today, if we can see 2% up, 3% up, don't forget that squeeze in the S&P. I think it's only going to assist that move up to 60.50 in the S&P 500. Okay, that's then a wrap for today. Like I said, there's a number of things going on. We do, of course, have the penultimate trading day today before we move into month end tomorrow. So you'll expect a little bit of flattening type plays in the bonds. So there will be some opportunities to play, particularly in the long end of the bonds in the US curve. Apart from that, in terms of the data, we've got a number of Fed speakers today. Pretty much everyone is speaking today. They're all going to be waffling on. But like I said, keep a close ear for the QT stuff. That's ultimately where the attention of the market is right now. Make sure you know what to do if we do start to hear more and more chatter, this idea of a pause on QT coming a little bit sooner than expected. Aside from that, we do have some secondary data like durable goods, initial jobless. Of course, that will create a little bit of noise, but nothing that's going to significantly dent this idea of a growth slowdown. Okay. Aside from that, if there are any other questions, make sure you post them in the Discord channel. Otherwise, as always, it's going to be a little bit more volatile today, so manage that risk. Good luck out there. Go make some money.